We can put that check in a money market mutual fund. Then we'll reinvest the earnings into foreign currency accounts with compounding interest, and it's gone.
Hedge funds have historically gone far and wide to try to find ways to earn returns greater than the stock market. If you are someone who has earned over $200,000 in the past 2 years or have assets worth over $1 million excluding your primary residence, then you qualify as an accredited investor, meaning you can invest into hedge funds. In this video, we highlight 5 unusual and cool strategies hedge funds have used to make money in and out of the stock market. Kindly like, comment, and subscribe. 5. Whiskey. In May of 2018, a rare 60-year-old bottle of Macallan whiskey was sold for $1.06 million, setting a record for the most expensive bottle of whiskey ever sold. However, that record did not last long when a bottle of Macallan Valerio Adame 1926 sold for $1.5 million in November. Whiskey, as an investment strategy, has been growing over the years. Historically, hedge funds, like the Platinum Whiskey Investment Fund in Hong Kong, would require an investor to make a minimum investment of $250,000. But luckily for us regular folks, the first publicly traded whiskey fund has been released. It's called the Single Malt Fund, and it's listed on the Nordic growth market. The fund is targeting a 10% annual return and plans to sell its whiskey in 6 years to pay out its investors. But if your investment doesn't get the return you're hoping for, you can follow the advice of whiskey investor Tommy Tardy. If it doesn't pan out, you can always drink it. 4. Stringed instruments. If you happen to find a violin lying around your house that has the name Stradivarius or Delgado on it, you can consider yourself an accredited investor. That is, those violins can be sold anywhere from $2 million to $20 million. These 18th century violins are well known for their sound and tonal qualities. They command high prices for their distinct quality. For these and other prestigious stringed instruments, their values have climbed at a rate of 12 to 15% annually. Oddly enough, they seem to have a steady rate of growth with little volatility. This makes investing in these world-class string instruments a very attractive investment strategy to those who can afford it. However, you might have to pay part of that to a broker. Unlike many types of alternative investments like wine, whiskey, and art, these violins are usually tracked and sold by a very tight-knit group of brokers who have an idea of who owns what violin and where. 3. Life insurance settlements. Since 1911, the Supreme Court has determined that life insurance can be bought and sold on a secondary market. That means that you can sell the rights of your life insurance settlement to a fund for cash now. That means that you are forfeiting the right of your settlement to the fund. The value a fund might pay for your settlement rights is likely more than the cash you would get if you terminated your policy, but much less than the settlement value after fees. The return on this investment can range anywhere from 8 to 10%. Of course, higher returns depend on the very morbid belief that more people will die than not. 2. Water rights. If you think that some areas are getting short on water, you might want to consider purchasing a part of a river or lake. In fact, that's exactly what water asset management does. In 2018, the New York hedge fund purchased water rights in Colorado's Grand Valley. In an area that often faces many water shortages, the company could sell water in times of drought. Although they mentioned this is not their intention, bodies of water as an investment vehicle may actually yield a pretty good return. Water Asset Management says that they aim for a 17 to 22% return on water investments. The strategy makes a lot of sense. It is much like owning rental property. You enjoy the benefit of both the rise in the value of the property as well as rent. In this case, you are selling the water on the property. 1. Satellite photos. Satellite photos are a very odd but incredibly intelligent way to invest. There's an old story that says that Sam Walton would go into Walmart's parking lot every morning and count the number of vehicles in the parking lot. This would give him an idea as to how the company was doing. Hedge funds have since turned to satellites to gather this very insightful data. Companies like Digital Globe sell satellite imagery with frequent updates, giving investors insights as to how a particular company might be doing. UC Berkeley conducted the study on some of this data to see if it would return greater than the stock market. To their surprise, if there were an abnormally greater number of cars compared to a prior quarter and you purchased a stock a week before the earnings, You could return 4.7% greater than the market, which is a huge return. Although there has been a huge shift to e-commerce, making the strategy a little more difficult. There are still businesses where you could track this. If you were to take the satellite imagery from McDonald's, you could get an idea as to whether or not there is an increase in the number of McDonald's customers compared to prior quarters. Thanks for watching this video. If you liked this video, give us a thumbs up and subscribe.